Hi everyone, my name's Darryl Panes, CEO at As Good as Gold Australia. And this evening, once again, I'm joined by my brother Brian and partner at As Good as Gold.
Thank you, Darryl.
And tonight we interview Alasdair Macleod, advisor to As Good as Gold Australia. Good evening, Alasdair.
Good evening, Alasdair.
Good evening to you both.
Look, Alasdair, Brian and myself, have had a remarkable last month. It's just been so busy. Everyone wants to buy gold. There's an enormous rush. We don't have enough office space at the moment to cater for it all. It's just flying out the door. But we thought it was busy 2 or 3 months ago, didn't we?
Yeah,
but
I know, but we didn't think it'd get busier.
No. How is that possible? But it is.
It is.
And we've had to cope with it, and we're loving the heck out of it. We're gluttons for punishment, aren't we, Brian?
Mm. We certainly are,
but
on a day-to-day basis.
Yeah. But as what we've noticed, of course, we've all noticed, is that even though we're busy, and the markets are busy as well, of course, but turmoil is underway. And you look at all markets at the moment, stock market, of course, the Dow Jones has experienced its biggest single day crash since 2020. It's down 1,350 points overnight. This is like 48 hours ago. And the All Ords here was bathed in a sea of red at the same time. Bitcoin, of course, lost something like 10% overnight. Just in a night. And, you know, I'd love to see Bitcoin do well, but...
Oh, I would.
It's an alternative form of currency, but it hasn't got any history behind it, so it worries me in that respect.
Yeah,
I mean, gold, 5,000 years of monetary history, we know what it does in certain circumstances. We don't know yet what crypto does. But property values, let's look at property. I mean, here in Australia, Alasdair, even mainstream media is now reporting that the main cities, the main eastern state cities, that is Melbourne, Sydney, Brisbane, property values are depreciating at the rate of $1,000 a day at the moment here in Australia. So, you know, you multiply that out over a year, and if it maintained those sort of numbers, you'd be talking it's $365,000 in a year on a median property. So, you know, the markets really are finding it really hard at the moment. And about the only thing that stood up, of course, is gold and silver. And silver has done really well. It's up 10 or 12% over the last week and a half. So all bar gold and silver, everything else has really fallen in a huge hole. What I would like to ask you, Alasdair, is this. In particular, in the stock market, do you believe these two big falls that we've seen over the last week and a half, 2 big nights, over 1,000 points on the Dow, do you think this is an indication of more to come? Let's say over the next month, 2 months, 3 months leading up to Christmas, what are your thoughts?
First of all, I'd like to say I'm delighted to hear that the Australian public are being very sensible, buying gold and silver, physical gold and silver, off companies such as yourself, yours. That heartens me quite a bit, and it heartens me because there's obviously a growing band of people who recognize the difference between real money and the fiat currency world. And it's the fiat currency world that you're referring to when you talk about property values, when you talk about stocks, shares, whatever. The answer to your question is yes, I do see further falls. And the whole thing hinges on bond yields, government bond yields in particular. And I've got a chart here of the US 10-year note bond yield, which is just below the high which is achieved in was it early July or late June? It's about to break through the 3.5% level. Now, I mean, so what is 3.5% yield on the 10-year US Treasury compared with the declared rate of consumer price inflation in America, which is sort of is backed off a little bit, apparently, but this is statistical aberration. You're looking at well over 8%, and quite frankly, and I'm sure we'll come to this why a little later in this, the inflation rate is going to rise. It's going to rise quite a bit further. I'd like to talk about that if you want to ask the appropriate question, because I can explain that. We are going to see higher government bond yields, and all fiat valuations take their cue from that. Everything from property, which basically the marginal financing or the pricing, the marginal price of property is based on the cost of finance in the form of mortgages. And if the mortgage rate goes up, property values go down. It's pretty simple. Then there will come a point, I believe, where in a general currency collapse, real asset values will detach themselves from the declining value of money. In other words, property, you'll see property prices stabilize at some stage and then rise. They will fall very heavily in gold terms, because under those circumstances, real money will be only available at huge premiums, because there's not a lot of it compared with all the currency that is being destroyed. So I think, Darryl, the answer to your question is yes, I do see further substantial falls in stock markets, because not only are we not done with the rise in government bond yields around the world, but they are going to rise considerably further, and that's going to create even more difficulties for governments whose budget deficits are going to increase very substantially as a result of the contraction of bank credit, which I think we've discussed before. Bank credit is what all GDP transactions are settled in. And therefore, when you see changes in GDP, it's not necessarily reflecting improvements in the economy or recession, deterioration in the economic outlook, whatever it might be. No, what it's actually reflecting is the amount of credit deployed in the economy. And if the banks contract the amount of bank credit, bingo, you find GDP collapses. And this is what we now face, because, as we've said many times before, the commercial banks are very highly leveraged. They now see the economic outlook as deteriorating quite rapidly. They cannot afford not to really rein in their loans to the private sector. And this is particularly small and medium-sized businesses who find that liquidity just completely dries up. So what happens then is you find that businesses start going bust en masse. And it's not necessarily the big businesses who can rely on government contracts or whatever. Or you find the central bank turns around and says to the commercial banks, for goodness sake, you cannot foreclose on, I don't know, name any big business you like, from mining to manufacturing in your country. They will be lent on to keep the big businesses going. Okay, so if that's the case, I've got to close down everybody else because I'm over leveraged. My balance sheet, I've got to look after my shareholders. To hell with the regulator, I've got to look after my shareholders. And that's the position that bankers are rapidly getting themselves into. So we can see that with credit withdrawn from the economy, this is commercial bank credit being withdrawn from the economy. We face not only sharply rising prices as a result of the falling purchasing power of our currencies, but a falling GDP as well. Now, this is a lethal combination as far as the authorities are concerned, because this is reflected in rapidly increasing budget deficits, which have to be financed. Oh, but we've got a problem, Houston, because it's all very well saying that, we're going to need to borrow another $1 trillion or $2 trillion or $3 trillion or $4 trillion, whatever the figure is. But this is on rising bond yields. The market is not going to let us have this, to finance this at the levels to which we have become accustomed. So this is a situation which could begin to very rapidly deteriorate. And under those circumstances, I would not hold any equities, nor would I hold any fixed interest bonds. There is only one thing to do, and that is to try and get as much as you can out of the fiat currency paradigm and hold real money, which is metallic gold and silver.
Yeah.
Spot on.
Well, I'd have to agree, and we keep sharing that information with our guys all the time. What people don't understand, you just talk real money, gold. What I suggest to people is that, and no one understands this until it's explained to them, but all you're really doing when you purchase gold is exchanging one form of currency for another. That's really, or one form of money, if you want to call currency money, but one form for the other.
Okay. Just interject there, Darryl. There is a very important difference between money, legal money, which is only gold, and silver. I mean, in the past it's been silver, but in this modern world, we refer to legal money as gold. And this is what J.P. Morgan said, before Congress in, I think it was 1912. He said, gold is money and all the rest is credit.
Credit, correct.
Yeah. And he wasn't stating an opinion, which people might think. He was actually stating a legal fact. And this is another thing where the cryptocurrency people, they just don't get it. A cryptocurrency is not money. There's no way it's money. And there is no way that it's going to replace gold. And not only that, but even gold and currency has a different position in law from a cryptocurrency backed up by blockchain. Why? Because a cryptocurrency has the same position in criminal law as a work of art, your ownership of a property or whatever. If someone steals it off you, you can reclaim it without giving any compensation whatever, because someone steals it from you, it is still your property. Someone steals your wallet, and whether you've got gold coins in it or whether you've got Australian dollars in it is immaterial. If that gets passed on to a shopkeeper in return for goods, you can't claim that money back. It's not yours anymore. In other words, the possession of it it transfers. All you can do is you can have a redress against the criminal who stole your money, but you can't get your money back. When it's an artwork or something like that, something physical, and when it's a cryptocurrency, you can say, no, that's mine. And in the blockchain, there is a self-auditing process, which, and I don't know, I don't know whether it's possible to do this yet, but in theory, you can then trace back the previous ownership of every Bitcoin and bit of Bitcoin that you have in your possession. Now, if the authorities, let's say, decide that the Bitcoin which you think you possess was obtained by criminal means, whether it's the proceeds of money laundering or whatever, the proceeds of crime, then you've lost possession of it. It's not yours anymore. And so, there's no way this can actually work as a form of currency or money or anything else. So I think it's important to get that absolutely clear. And everybody should understand this. They're under a misconception about cryptocurrencies. The only thing that cryptocurrencies could do is they can set themselves up as an alternative to depreciating state currency, not as a currency, but as some sort of financial asset, which will tend to hold its value better than a depreciating currency. That's it. And when you get a collapse of the currency, how are you going to price your Bitcoin? The answer is that if there's no currency, there is no Bitcoin. It's as simple as that. Yeah. You might have you've just got an empty blockchain. Brilliant. And everybody, and this is without exception, everybody who owns Bitcoin or similar stuff in the cryptocurrency field, they take the view, I buy my Bitcoin because I think I can sell it later at a higher price. Mm-hmm. In other words, they're looking at it as a financial trading asset. Yeah. That is not money. We are talking money. Now, admittedly, a lot of people punt in gold thinking that, I can buy it today. I think it's going to go up, so I can sell it at a higher price tomorrow. But they are mistaken in their approach unless they're speculating in paper gold. That is a completely different thing.
Moving on, Darryl and I have always had the quote, "Be careful of who you listen to." Because there are some exaggerators out there, and there are also a lot of people who talk false truths. But there seems to be a lot of crystal balls. People saying on this date this is going to happen, this date that's going to happen. But the reason why I bring this up, I was looking at an interview of on one of the Canadian news sites, and I'll read it out, and then we'll move into it, and you'll get the gist of this. Came across an article where there was an interview with a 2013 Nobel Laureate. His name is Eugene Fama. I hope that's how it's pronounced. And is an economics professor in finance at the University of Chicago. He stated that gold was a terrible hedge against inflation. So now I would like to put up on the screen what you have done, Alasdair, that you produced only a few months ago. Now, I've done this once before, and I'm going to do it again because I'm going to emphasize the fact that this gentleman, who is a Nobel Laureate, that I believe is wrong. All right. So, a month ago or so, you'll recognize these, Alasdair, that the price of oil looks like that in US dollars and in pounds and in yen, I think it is. But there's about 4 different currencies. But we'll stick to the US dollar price. So the price of a barrel of oil is from 1950 to 2022 is up 39 times or 3,900%. But there's a horizontal line on this graph here, and that's representing gold. So the gold price of a barrel of oil over 70 years is actually down 30%. Now, the next one. The next one is the price of copper. And the price of copper is actually from 1900 to 2022. And in US dollars, it is up 27 times over 120 years, 2,700%. But in gold, down 70%. Next one, iron and scrap steel. This graph, you can see that there's always a horizontal line on these graphs, and the horizontal line is representing the same item, in this case steel and iron and steel, but priced in gold. So in US dollars, it is up 69 times, 6,900%. In gold, this time around, it's up in gold. It's actually up 32% against 6,900. Right, and I'm showing these because, I've got one more to go, showing these because these are facts. And Alasdair, you are so right, these are facts that can't be distorted. Now, this is the price, a house price in London. Now, it's very, very similar to a house price in Sydney, 1968 to 2022, 54 years, where the median price went up 115 times in London, 11,500%. In the gold, if the price of the house was priced in gold, 29%. Over 54 years, gold price, if it's priced in gold, 29%. Now, I don't know how much credibility this gentleman actually has, but this is what he actually said. I'll read it out to you. Nobel Laureate in economics says Bitcoin's true value is 0. Well, I think he got that right anyway. But gold is a terrible inflation hedge, Darryl. Terrible inflation hedge.
Yeah, no, I couldn't believe it.
I couldn't believe it. Bitcoin and gold are bad long-term investments. Now, there's the key. Bad long-term investments. The key investment. It's not an investment. Said Eugene Fama, 2013 Nobel Laureate in Economics and Professor of Finance, University of Chicago. When it comes to gold, Fama stated that it has a high volatile price and is a terrible hedge against inflation because its price is too variable relative to the price of goods and services. Now, ladies and gentlemen, I just showed you 4 graphs of copper, oil, real estate, and iron and steel, scrap iron and steel. And the horizontal line represented gold. I would consider that no inflation at all. So, Alasdair, a few comments.
Well, not only no inflation, but very low volatility. And I mean, you can take this way back. You can go back to Diocletian's edict, which I think was something like the 3rd century AD, beginning of the 3rd century. And I mean, you can extract all the prices, and they have varied a bit. I mean, which is actually quite nice, because Diocletian also put a maximum price on gold and silver. And from memory, I think the gold-silver ratio was 6 times, by the way, which is interesting.
There you go. Yeah.
But because you've got a price of gold and you've got the price of everything else in the currency of the time, you can work out the gold price of all these things. And a few things have disappeared from the market, like slaves. For example, we don't price them anymore. But things like a military coat, sort of different forms of food, meat, and so on and so forth, you can price these. And some of them have varied very, very little over the years. It is quite extraordinary. I mean, a short jacket, in other words, a blazer, if you like, today. But in those days, it was the equivalent of a sort of a short military jacket. It's exactly the same price. But I think that there is another point which is worth making about all those charts, and that is, as you rightly say, the volatility is not in gold, but it is in the currencies. But we can go one further and say, when you look at all these commodities, the volatility is not so much in the commodities themselves, though individual commodities will move against each other, but actually in the currencies. Now, the whole point about a medium of exchange, currency, is you've got to regard that in a transaction as having a value we can all agree on. So, if you want to sell me something and we can agree what an Australian dollar is in that. I mean, we're not going to dispute the Australian dollar, but we might argue the toss over, let us say, I don't know, pair of shoes made out of kangaroo skin or whatever it might be. I'm just making something up. You might think it's worth more as a seller than I think it's worth as a buyer. And but we're always talking about, the constant in the transaction is not the value of the product; it is actually the money. Now, what those charts show actually is that when it comes to commodities in particular, the volatility, we should be thinking in terms of, we should be looking at it the other way around. Copper, for example, might say, how many tons of copper am I prepared to accept for these dollars? That's the way we should be looking at it. That's what this volatility is telling us. In other words, these paper currencies are not fit for purpose. They really are not. They are introducing volatility into everything.
Yeah.
It is not the products which are volatile. It is the currencies themselves. And that is something that's going to destabilize them at some stage. And I think that's the very, very important point to understand.
Yeah.
I mean, you're absolutely right about gold. Gold is money. And as to the point that this professor, I mean, first of all, there are an awful lot of professors who think the way he does because they're all taught that. I mean, I remember talking to Max Kaiser about a time he was invited onto the BBC to discuss gold with a representative, an economist from The Economist magazine. And the guy from The Economist magazine was a young guy, absolutely clueless. He sort of pushed the Keynesian line, which, The Economist does all the time. And Max couldn't help but notice that they had a Bank of England bar, a 400-ounce bar there, sort of just to top up the program, as it were, along with security and everything else. And guess what? This young man, while he was denying that gold was any more than a pet rock, he was absolutely fascinated by it. So, I mean, but anyway, putting that to one side, look, the only form of money which is stable, and this is why it is money, is physical gold. The rest of it is credit. Forget it. Credit goes up and down unless credit is sensibly anchored, credibly anchored to the value of gold. Then you have got a currency which is stable, but not unless.
A good answer. I'm sure, Eugene, you must have come from the school of Keynesianism.
Oh, completely. I mean, I'll tell you something else. I think Professor Stiglitz is on record somewhere of advising the Venezuelan president Chavez, the early one, that his monetary policies made an awful lot of sense and would stimulate the economy. Whoa!
Yes, it's so incredible how you look at things. Going on to another question here, Alasdair. There is a lot of discussion. I'm reading it, and a lot of people I'm talking to also bring it up as well. There's a lot of discussion about the Moscow World Standard for Gold, a new gold-backed multi-currency system. In actual fact, Alasdair, you wrote an article for Gold Money on September the 8th explaining this. You titled the article An Asian Bretton Woods. Could you talk to our audience about what this article is all about?
Yeah, and what I'm doing, perhaps slightly naughtily, as it were, is conflating two separate events. There's a guy called Sergei Glaziev, who is a very senior Russian economist, senior in the Russian government, who heads up a commission appointed by the Eurasian Economic Union to recommend a new trade currency for settlement between the members. And part of the brief is that this new trade currency should be available for other countries to join. It's not a domestic circulating currency. It is purely a trade settlement currency between initially members of the EEAU, then the Shanghai Cooperation Organization. It's expected that it will be available to members of the SCO and also members of BRICS. And BRICS itself is expanding somewhat. I mean, there are talks going on about other countries joining BRICS. And even countries like Saudi Arabia are talking about getting in on this some sort of Asian Act. I mean, I've read that they're looking at joining BRICS. Whether that's true, I honestly don't know. But there's no doubt that the Saudis want to get involved. So this new settlement currency is actually potentially a huge deal if it actually comes into existence. The objective is basically to drive the dollar out of Asia, out of the countries which participate in it. They will no longer have to, sort of buy dollars in order to do a transaction from currency A into currency B. Because, the way it works is you sell currency A for dollars and then you sell dollars for currency B. So that the idea is basically to do away with that. Now, the original proposal, which was a sort of outline thing, which was exposed by the press. I mean, these are press comments, informed press comments, but if you like, sort of very early stage. Was that this currency would be comprised of a basket of the participating currencies and the commodities that are commonly traded between the countries. Now, that just doesn't work because every time someone wants to join in, you've got to rebalance the basket. So there's no stability if you do this with the currencies. You have the same problem with the commodities because you've got changing commodity patterns and all the rest of it. So, I mean, the way it's been put forward, there is a lack of understanding of really what the objective should be. And quite clearly, I mean, in that Gold Money article, I sort of walk through commodity prices in dollars and then commodity prices in gold, because if you're going to get away from dollars, you've got to go get into something else. Well, what is that something else? Obviously, there's only one thing, and that's gold. So, pricing it in gold, it comes back to the point that we've just discussed, and that is that if you want to see ultimate price stability, you price things in gold. And that indeed is what the chart reflects. Now, the fascinating thing is that we then had a separate announcement from the Russians that they were setting up this new Moscow gold standard, really as a response to the LBMA kicking their refiners out of membership. It was very much promoted as that, and they were going to do exactly the same sort of thing. There's going to be a fixing committee and whatever, and various Asian nations would be invited to join in, etc., etc. Now, two things about that. First, what is this new Moscow gold standard? I think quite clearly there's only one standard unit rather than the 400-ounce bar. What we're now looking at, I think, is the Chinese 4 nines 1 kilo bar. That's going to be the unit. Even the Arabs own those now. They are ubiquitous throughout Asia. There's no point in inventing, a new sort of Moscow weighting standard bar. Forget it. That's nonsense. So this is going to be based on the Chinese 4 nines 1 kilo bar, which everyone in Asia has now. That's the first thing. The second thing is, and I didn't really, I think, bring this out enough in that article for Gold Money, is guess who is behind all this? One Sergei Glazyev, the same guy who is putting together this Asian currency. What does that tell us? Well, it tells us that the earlier stuff about, this is going to be, his currency is going to be a mixture of participating national currencies and, sort of weighted commodities, traded between them. It's a load of rubbish. Actually, what we're moving towards is some sort of gold backing for a new trade currency. Now, I think that makes sense because, well, two things. First of all, the Russians have got a lot of gold. Independently from me, a great friend, Simon Hunt, whose knowledge of the Asian continent is really based very much on copper, but it also extends to other things, and particularly geopolitics and information which perhaps we'll say is intelligence derived as much as anything else. So he is a very well-informed individual. And there is another fund, I can't remember what it's called offhand, Grow Fund or something, which holds a lot more gold than the Reserve Bank. And so their total gold holdings are around about 12,000 tons. That's the first thing. Now, bear in mind that America claims to hold 8,133 tons. So the Russians have more in a far smaller economy. So they've actually got some pretty good gold backing. The Chinese equally have substantial amounts of gold, which are undeclared. And I think we've talked about this before. I would not be surprised if the state comes up with over 30,000 tons of gold if they declared it completely. The reason they haven't declared this is because it would destabilize Western currencies completely if it came out in the open that Asia is going on to a gold standard. But things have changed hugely since sanctions were imposed on Russia. They now need to protect themselves from collapsing Western currencies. And that's a completely different thing. Instead of being accused of collapsing Western currencies, they now need to protect themselves. And I think that's the importance that we should really take very seriously. First of all, this sort of rather bizarre plan to put together a settlement currency for Central Asia, and then the Moscow gold standard suddenly being announced by exactly the same man, Sergei Glazyev. He's behind both these. So in my mind, this is a lot more than just coincidence. It's something we should take very, very seriously and is an interesting development. And I would personally say that, bring it on. I would like to see that because I don't want to see any of the world disappear under collapsing fiat currencies. So I do not hold a candle for China or Russia or any government for that matter. But I'm just thinking in terms of the people. If they do that, then they're going to insulate more than half, potentially more than half the world's population from our mistakes, our currency mistakes. And you cannot criticize that. You really cannot.
I totally agree.
A gentleman by the name of John Butler, who is the author of a book, The Golden Revolution, How to Prepare for the Coming Global Gold Standard. Pretty experienced gentleman. He has 25 years experience as a top executive within the banking sector, including Lehman Brothers. But he talks about a reset and a gold standard. And he's suggesting in his book, and I saw him interviewed just recently, he's talking about 2 years. He thinks it'll all take place within the next 2 years. And he said, I believe, for a whole number of reasons, that gold will probably be revalued at around $50,000 an ounce. He said it has to be somewhere around $50,000. What are your thoughts? Number one, his projection so far as 2 years, and then valuing gold in a reset at, say, $50,000. What are your thoughts?
Well, firstly, I know John very well, so
okay.
And indeed, I have read his book, and I helped go through the revised edition. So I have to scratch the little grey cells in my brain a little bit, but
nice to hear.
I know where John is coming from, as they say. So I mean, well, firstly, the timescale. We cannot know the timescale. I mean, this was written a little while ago. I mean, he may have revised it again. I don't know. But I can tell you that things are now beginning to evolve really quite rapidly. So in that sense, I think he's probably not too far off. When it comes to the $50,000, I'd rather look at it differently from John in that respect. I think that has to be a guess on his part. It's sort of penciling in a number. But we know that the Americans are anti-gold and pro-dollar, and good reasons why they should be, because they've promoted it to be the world's reserve currency. Everything is traded in dollars. They could no longer stick with even the sort of merest relationship between the dollar and gold, which is why the Bretton Woods thing ended in. So what we're talking about is a deterioration in the situation of the dollar to the extent they have to throw the towel in on gold. Whether it's $50,000 or not, I honestly don't know. But the reason they will have to throw the towel on gold is really very, very simple. With the dollar collapsing, under what would not, what is sort of commonly termed hyperinflation, but I think a better description is just complete loss of credibility and purchasing power. Under those circumstances, the only way they can stabilize it would be to go back to accept that really is gold, and they need to anchor the dollar to gold. Mm-hmm. I think it's quite possible that you might see the dollar go down to the point where they're considerably more than 50,000 to an ounce of gold. I really don't know. I mean, that is ahead of us, but there are going to be extreme difficulties, I think, for the Western fiat money establishment, fiat currency establishment, extreme difficulties for them to accept the reality of the situation. And so that's really what we're talking about. I mean, it could be anything, and it's going to be different for different countries. I mean, Canada has sold all its gold, got none at all. Britain under Gordon Brown sold 2/3 of its gold, which wasn't very clever. And so far as I'm aware, the Treasury has made absolutely no attempt to recover any of the gold that it lost at under $300 an ounce, by the way. countries, bizarrely, seem to have quite a lot of gold. I mean, places like Turkey, whose currency is collapsing.
Yeah.
And interestingly, going back to if you like, the Russia-China axis, I mean, if you look at the who's actually been buying gold in the central banks, it's been predominantly, Shanghai Cooperation Organization members of the, and their associates and sort of partners, also other members of the Eurasian Economic Union. If you take all those together, they've, accumulated far larger amounts of gold than any of what I would call the sort of either Western aligned or non-aligned nations' central banks. I think we're looking at something like over 4,000 tons as against 800 tons. This is quite an important signal, I think, that there's going to be a more ready acknowledgement and acceptance that currencies should be linked to gold in Asia than is likely in the West. But really, as to John's point about $50,000, I think that can only be sort of a pencil-in figure. I don't know whether he looked, say, at the quantity of money supply relative to gold ounces held by the US government. I mean, people do that sort of thing, but you can't, because for a start, the US government reserves haven't been audited, and B, really what you're looking at is a situation which is going to deteriorate from now. You can't really think in terms of, you can't really say, if the situation stopped now, then they would need to have so many, the price of gold would have to be whatever, because that's not happening. This is, we're getting a rapidly deteriorating and accelerating deteriorating condition for fiat currencies. So we cannot guess what the outcome will be in that sense. But what I can tell you is that they will have to go back to accepting that gold is money and all the rest is credit. And the only way to stop the collapse in the value of that credit is to anchor it to gold. How long that will take, what we will have to go through to get to that point, I have no idea. All I just know is it's going to be very, very difficult for us because we don't, our economic establishment just don't understand money.
Do you think it might be more along these lines, based on what you've said, that it's not so much what gold is trading at in dollars, in US dollars, 1,800 spot an ounce, who cares? I mean, you look at a Venezuelan family and they probably couldn't care less what gold was trading at or what in US dollars. But what can I exchange for my ounce of gold is what is more relevant to them. Do you see that being more the case as to what you can exchange for it in preference to its dollar value?
Yes, I mean, you've got to think in terms of goods. But having said that, as fiat currency collapses, then the value of gold in terms of goods is going to rise. I mean, in other words, the prices of goods are going to fall very substantially. And we even saw that in the 1930s. The reason that we were driven off, or rather America was driven off the gold standard at 20.67 to the ounce at that time, was simply because they needed to devalue the dollar. If you looked at the prices of goods and services, gold terms, then the fall in price was even more dramatic. In other words, the purchasing power of gold was down. So it's going to be a combination of things, but most of the change in prices is going to come from the collapse in the purchasing power of currencies.
Right.
Yeah, I mean, you and I have always said it's not gold or the US dollar. What is a US dollar? I mean, it's a piece of paper with a bit of ink on it, and it has a so-called value on it. But at the end of the day, how many of those pieces of paper will gold buy? You'll buy 1 million of them if it needs to be.
That's right. Yeah. Exactly.
Yeah.
Brian.
I've got one last question for myself, and I think we'll probably finish off after this, but we'll see how we go. I think people that view this station, this commentary, As Good as Gold Australia, know that I'm a sound money person. They certainly know I'm a gold standard person. But I read another article, and I just want a few comments from yourself, as I always do, Alasdair. The article is about sound money can prevent what representative democracy does not. It's a very good article, and it comes from Patrick Barron via Mises. So I'm going to read a few paragraphs out, but it's the last paragraph that I'd like probably the comments made on. So, yes, basically, sound money can prevent what representative democracy does not. Mises wrote repeatedly that unsound money was just as important, perhaps more important, than the trappings of popular government. Quote, "It is impossible to grasp the meaning of the idea of sound money if one does not realize that it was devised as an instrument for the protection of civil liberties against despotic inroads on the part of governments. Ideologically, it belongs to the same class with political constitutions and Bill of Rights. The gold standard has one tremendous virtue: the quantity of money supply under the gold standard is independent of the policies of governments and political parties. This is its main advantage. It is a form of protection against spendthrift governments." My last paragraph. This is the one for comment. Which works better, gold or representative democracy? In other words, gold would have done its primary duty, that is, make the real cost of government spending perfectly clear so that people, through the elected representatives, can decide the extent of government spending. Instead, the complete absence of any kind of objective barometer of the real cost of government merely encouraged United States neoconservatives to search the world for dragons to slay, and if dragons were hard to find, to convince the people that the dragons existed in places very far away. Example, Libya, Iraq, Syria, Somalia, Afghanistan, Ukraine. Have I missed any? And were a threat to our way of life. Few, if any, of these failed adventures would have been undertaken had the US been on an enforceable gold standard. Comments?
Absolutely true. Actually, Pat Barron is another friend, so I'm perfectly aware of his views and of that article, and he's aware of mine too. So, we're doing maybe a bit of groupthink on right. This one. But no, I agree with him entirely. He's absolutely right. And I mean, even Stalin was reputed to have said that, debauching the currency and wipe out the middle classes. In other words, he would see money, unsound money, as a weapon in his armory, as it were. But no, I think Pat was absolutely right on that. I mean, the whole history of wars is you print money to fight a war. You don't tax people, otherwise you won't get the support of them. We saw this with Germany in the First World War. The war was entirely fought on the back of printing money. They suspended convertibility for the mark at the beginning of the war. We suspended convertibility of sterling into sovereigns. And if you look at the American situation, I mean, the whole of Korea, Vietnam, and all subsequent actions have all been done on the back of the expansion of money, not necessarily recorded anywhere within the domestic US financial system. Too often you hear of sort of, plane loads of, like $10 billion in dollar notes going into places like Iraq or Afghanistan, and this is all money to go and bribe people or pay for this, pay for that, whatever. And it was that really led to the end of the Bretton Woods thing, because one of the knock-on effects of the Vietnam War was what had been French Indochina became flooded with dollars printed, to pay for the war over there. And it was really France under de Gaulle and Jacques Rueff, his economic advisor, who insisted on selling these dollars which they acquired as for the Fed's gold, for the US Treasury's gold under the Bretton Woods Agreement. That led to the setting up of a gold pool, because the Americans saw the gold was just running out the door, because it wasn't just Jacques Rueff and de Gaulle doing this. There are others getting in on the act as well. So they set up the London Gold Pool. That failed in the sort of late 60s, and there was a bit of fiddling around, and then eventually Nixon just pulled out of Bretton Woods. That was the end of it. So, I mean, the answer is yes. Politicians use unsound money to further their objectives. And that is exactly what we're seeing today. I mean, when it comes to COVID, how do they finance COVID? Shutting down all the businesses. Oh, don't worry, we'll make the money available. Print, 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 print. Energy. Now, that's the next one. In Europe, how are they going to pay for the higher energy prices? Oh, don't worry. If your bills in this country, if your bills go over £2,500, we will pay the balance, says the government. And this is a new free market government. Not only are the British government going to pay £2,500, the excess over £2,500 on everybody's energy bill, but they're going to support businesses as well. They're going to pay their energy bills. Now, the mechanism by which this happens, I think, is going to be extremely complex. I haven't a clue how they're going to be able to do it, but it's not just us. Switzerland are doing the same thing, and Europe. They've got to bail out their businesses. They've got to bail out people, because there's going to be huge hardship. Interestingly, the emphasis is probably moving away slightly from gas, which has really been hitting the headlines. I mean, soaring gas prices. It's going to move to electricity. And the reason for that is that France has roughly half its nuclear power capacity shut down at the moment. A lot of it's for maintenance. There's 16 nuclear reactors shut for maintenance. There's a further 4 which have serious cracks in the cement and all the rest of it, and are going to have to be recommissioned. There is a further 12 which unfortunately are suspected of having cracks in the cement and so on and so forth, so might have the same problem. France is now looking to import electricity from other countries, including the UK. But the UK is looking to import electricity from France. So, this is
what a mess.
This is the stupidity of energy policy coming back to bite us big time. And it's going to require an awful lot of, expansion of credit. I mean, unfunded government spending. And not just that, but you've also got the German economy is teetering on the brink. That's going to effectively fall over. And you've got the Eurozone with the ECB and the Euro system in negative equity. And I think we've discussed that one on a previous episode here. And the reason for that is that the value of the bonds which they bought through quantitative easing have fallen, and they're now deeply negative equity. I mean, this is actually a very serious problem. And how do you refinance that with target 2 imbalances? Refinancing something like the Bundesbank, which would have to happen. The politicians in Germany would be trying to sort of work out not just refinancing the Bundesbank, but the Bundesbank's contribution to refinancing the ECB. And I can see the questions on the floor of the Bundestag right now, So, this is This is horrid. It really is. Worse, even worse than that, the banks in the Eurozone are amongst the most highly leveraged in the world. The relationship between assets and equity. So, which basically means that virtually any write-offs of bad loans will just wipe out equity. It becomes one for one. But the leverage is just absolutely enormous. There is another problem, and that is that the repo market in Europe is the largest in the world. It's roughly 9 trillion euros of repos. And this is the reason it exists is because the repos are the source of the commercial bank's liquidity. Now, you get rising interest rates, that liquidity dries up. So, where do they go for liquidity? Whoops, we've got no liquidity. I mean, it's one thing after another. It's just getting worse and worse and worse. Yeah. But the real thing that I think is going to collapse the whole lot is the fact that these banks, and it's not just in the Eurozone, it's not just in Japan, it's all around the world, see rapidly rising lending risks. So what do? They're going to cut back on their lending. And they will particularly cut back on the small and medium enterprises that make up 80% of an economy. Why? Because, these guys have got no shout really with the politicians. The answer is you can foreclose on a factory employing, say, 300 people. They just get stuffed. Forget it. I don't want to take their losses. I want to get my credit back from them. Or I can liquidate the collateral. If they've got collateral, it's probably financial collateral, which basically means I sell it in the market, which drives markets down. So one way or another, this collapsing bank credit leads to a collapse in GDP because bank credit is the means in which every transaction in GDP is settled. And then what happens is that the central banks and government end up with a huge great deficit, and they're then encouraged on top of these huge deficits to have even higher deficits to stop the economies collapsing. Because the Keynesian thing is when an economy goes into recession, basically you've got to stimulate it. And how do you stimulate? You stimulate it by excess government spending. Yeah. I think it's that's really going to collapse it all. And these events could happen quite rapidly. As to John Butler's point, 2 years, I don't know. It's always a big mistake to put a time on these things, but I can see the circumstances whereby this crisis really does accelerate. And I can now see a number of the components that we're going to have whereby this is going to happen. So that's where we are.
No quick solution to this, Brian.
No.
And a little bit like Egon von Greyerz has been saying, this is going to go on and on and on. Very challenging times ahead. Thank you once again, Alasdair. Very much appreciated for everything you do for As Good as Gold Australia. I think more than ever, and we keep saying this, of course, but I think more than ever, the Jim Sinclair reference to becoming your own central bank is vitally important. Own gold, become your own central bank, own gold, just like they do. If it's good enough for them, it's certainly good enough for us. And Peter Daniels, of course, would always say, I do not care what poorly executed economic decisions are made in the world tonight, because tomorrow I'll still be able to party. Why? He owns gold. He has reserves. And that's where so many people are missing, or what they're missing at the moment. They don't have reserves. So it's important that you recognise that and start to make some changes. Egon von Greyerz, of course, Egon, upon being asked the question, Brian, how much should I invest in precious metals?
Well,
his answer is
a common thing that we've been talking with all of our clients just recently. But yeah, how much do you have? It's a question you must ask yourself. But his answer has always been whatever you can't afford to lose. So it's a great answer of how much you should have. And I will bring up the fact that we've been talking tonight about sound money on every occasion. And I think tonight we brought up also we were given sound knowledge. so from Alasdair Macleod. I think it should be taken as a very vital point.
Yeah. Yeah.
Very kind of you to say so. It's been very much my pleasure.
Not a problem.
Thank you, Alasdair. And thank you as well to our viewers and subscribers for the support they continue to provide this channel. We appreciate that support. And until next time, we'd like to say stay well, stay focused, and goodbye for now.
And goodbye for now.